Hello, we're live. I'm Mitch Goldberg with Client First Strategy. Thank you very much for joining me. You're watching a live stream or a recorded live stream of Mitch Goldberg. Be the boss of your money is the name of the stream because I want you to be the boss of your money, not your money to be the boss of you. So we're going to talk about value investing. It's always an age-old battle, value versus growth. I think growth has won the battle. Not to say, maybe growth has won the war, but not every battle will be won by growth. So let's take a look. We're going to dive into this and going to quickly explain to you how to know the difference between growth and value, how to pick a value stock or a growth stock, and what are the characteristics that you should really be looking for in terms of growth or value when you invest. So we're going to roll the intro and we're taking a deep dive, but we're going to do this quick. Thank you for joining me. Again, I'm Mitch Goldberg. You're watching Be the Boss of Your Money. We're talking about growth versus value. You really, if you can't be an investor without discerning the difference between growth and value. I'd like to welcome you to the live stream. If you're watching this in live stream, I'd love to answer your questions in the comments. If you're watching in the replay, hey, hit me up with questions there too. I'll be checking and I'll get back to you. Actually, I enjoy answering the questions in the comments. That to me, that's actually the best part of doing the live streams. The other best part, I guess, is seeing how I'm going to mess up a live stream and, try to fix the lights or something or the sound in the middle of it. So quick scratch. Okay. So today we're talking about growth versus value. Now, if you're a watcher of this show, we talk about a lot of things here. We talk about ESG investing. We talk about investing in 529 plans, personal finance, business, all sorts of investing. Today, we have growth versus value. So think about your growth versus value questions. If you also are a watcher, a viewer of the show, you know that we always like to do a quick rundown of the day's activity. So we're going to do a share screen and just give you a quick update in the market today. Today, another good day. Today, Dow up 267 points, up over 1%. S&P up almost 1%. NASDAQ up a little bit more than 0.5%. And the Russell 2000, that's a small cap stock, almost up 1%. And the VIX was down, which is a good sign. Yesterday, we saw the VIX up. You want to see the VIX go down on an up day in the market, because if the VIX goes up on an up market, it means that there's still a lot of worry, and we have to worry if that's going to, if the up market could, if the trend could persist. So that is that. So yesterday I did my live stream, talked about George Floyd, the protests, the riots. I got a little emotional. I was exhausted yesterday from the news and how hurtful and horrible everything has been. We watched a murder on TV, and I just want to reiterate that we separate the rioters from the protesters. We don't say George Floyd was murdered. Well, and then respond by saying, well, they should have been protesting. No, that doesn't fly by me. That to me is actually quite racist. We don't do that. Okay. So that's my view, and I'm sticking with it. And let's just take a look at some of the market movers on the S&P, some names you may have heard of. Nordstrom had a little bit of a bounce back. Everest Reinsurance, Hess, Qualcomm had a nice day. I'm glad Qualcomm had a nice day. That stock is doing a lot of good things as a company, but the stock has just been dead money for so long. And the downside, Tiffany, consumer discretionary. Consumer discretionary, like Tiffany jewelry, they make things that you want, not that you need. Okay, Las Vegas Sands was down. Gilead is the company that came out. They came out with a drug called remdesivir. That's the antiviral that is shown to work with COVID-19 patients. Ever since then, the stock has been going down ever since they came out with the news of that drug. It just, I guess the investors don't really believe it's going to be that much of a hit. It's the only thing I could come up with why that stock never goes up. And then let's just take a look at the sectors. This is the most important thing I look at every day. I look at 11 sector ETFs that represent the 11 general industry classification standards, or the general industries of the economy. Energy leading the way, materials, industrials, financials were up a little, not leading the way, but up a little bit. But overall, solid day in the market, and the stocks that you want to see lead were up. I mean, for the most part, it was a decent day. Most stocks obviously were up. And let's just take a look at a couple of things here. Actually, that's about all I want to look at with this. Energy has been moving up and doing a lot better. And that really, to me, is just a reflection of states are reopening. People are getting back to driving, filling up their tanks, spending money, going out to eat, getting haircuts, doing all the things that we do in an ordinary day. I don't know how much of things are going to be ordinary until some time passes. But nonetheless, we've taken the worst part of the recession and coronavirus off the table. So let's just talk real quick about the, I'm going to stop the share screen here for a second. Let's just talk about what's going on in the United States. So we've had about 2.5 months, or 75, 80 days of quarantine basically around the country. And then we have this situation with George Floyd. I've seen it. You saw the tape. It's like the most awful thing you've ever seen in your life. It's almost hard to believe you're not watching like a TV show, but that was real. You actually saw the process of a human being's life being taken away by another human being. It's so so with the protests, the riots, the curfews, literally all over the country. Why is the stock market going up? Because investors generally feel that we will get past this. The economy is reopening. Earnings will come back. Corporate finance will come back. There's a lot of good things to look forward to in the economy. Now, could the protests and the riots, could they have spread the coronavirus around? Yeah, they could have done that. They could have spread the coronavirus around a little bit, and maybe a lot more. It's tough to say. Plus, it slows down the reopening of the economy because you have major cities that are under curfew. It's the same thing as being in quarantine, maybe even a little worse. So we have to see how this affects it. I think this just drags out the states reopening a little bit longer, and maybe it'll add a little bit of money to the building materials sector, because all that glass and goods have to be replaced. These are very short-term blips, though. If anything, we need the states to reopen, and we need to see, early September to see what happens with COVID cases, to see if there's a rebound. Okay, so let's get into the growth versus value. Now, if you do have any questions about anything that I'm speaking about, you are more than welcome to ask me in the comments. I would love to answer your questions or your words of encouragement. Those are always appreciated as well. We're talking about growth versus value. The toughest thing about the growth versus value decision is that they are both defined in a way that is in the definition is in the eye of the beholder. That's the tough thing. Is a value stock something with a stock with a low price to book, a low PE ratio, a stock trading down to its or around its 52-week low? I actually don't like any of those metrics. And if I see any of those metrics, a low PE, low price to book, where stock trading at a 52-week low, those are actually, personally for me, those are the ones that I avoid, because stocks at a 52-week low typically go lower until something really improves with the company. The problem is obsolescence, or a company that no longer meets the needs of its customers. When you see a stock break through 20, That's kind of my golden rule. If you want to know, when I see a stock break below 20, that's a real problem. There is such a loss of confidence or such a disbelief by investors that anything good is happening with the company. And so many times, more often than not, I see a stock go down to 20, it goes down to 10. And then if it goes under 10, it goes down to 5. It's not a situation that I want to be in. It might mean that I miss a stock right off the low, but if a stock hits a low and can improve, things come back. Maybe things aren't as bad as you thought. That's okay. I don't mind jumping in then. I don't mind giving away a little upside to avoid a disaster. Investing is not always about making the most money, about maximizing your upside. It's also about minimizing your mistakes. That's why we use a very common tool called diversification. Diversification is not about maximizing gains. It's about minimizing losses, minimizing mistakes. Does it keep your account from going down in your portfolio? Does it keep your portfolio from going down in a generally down market? The answer is no, but it helps it keep it from going down as much as it could if it was concentrated in just a few positions that all would do badly at the same time. I hope that explains. So we're talking about growth versus value. I really have a lot of bad things to say about value investing, unfortunately. Now, you could say that's a recency because growth has been outperforming value for forever. I mean, I've been in the industry, the securities industry, since 1990. And I'd have to say the last 2/3 of my career, it's really been a growth market for as long as I can remember. And value is very tough. There used to be a time when you could find people who would get into value stocks because they had, companies had certain assets or overfunded pensions, unique situations. But it was also a time in the market when Fed policy wasn't so accommodative, companies weren't quite as big, and to me, the growth became the winner when the internet came out because of all the things that the internet allowed us to do. So value to me, when I see a stock that's a value, there's a few reasons why people say something's a value. One of them is because somebody buys a stock, it goes down a lot, and instead of saying they're wrong, they say, oh, well, now it's a value. Why would I sell it here? It's a value. If that makes you feel better and makes you feel less stupid, then go right ahead and say, well, now it's a value. It's probably going to become a bigger value, but at least to you, that if that helps you justify your decision, because the hardest thing for people to do is take a loss on a stock. Listen, from my experience, the number one reason people, retail investors, individual investors sell a stock is to break even, not to make money, not to lose money. It's to break even. Cheap for a reason. If something is cheap, what makes you think you know better than all of the other investors in the world? When a stock becomes cheap, a value, okay, when a stock is a value, it means there's something wrong. Now, I'm not saying like the whole stock market goes down, but nothing could be a value. But just because the stock market is down, it doesn't mean the growth ability and potential of a company is gone. Just want to point that out. I'm going to come full circle with all of this stuff, okay? The other thing is growth. The other thing is growth covers up a lot of mistakes. There are an awful lot of growth companies that make mistakes, that sometimes miss earnings, miss revenues. They make a lousy acquisition, but they're forgiven because they still have the growth, and the growth in their earnings, their revenues, it covers up a lot of the mistakes. Investors could be very forgiving when there's growth involved with a company, and investors could be very harsh and quick to judge a company when they make a mistake when there's no growth. That's the difference. And that's why you see such rapid reactions when companies make corporate announcements, such as if a company exceeds earnings expectations, often you see a pop in the price of the stock. Company misses earnings or revenues expectations, and you often see the stock get hit in aftermarket trading immediately because investors react differently to growth and value stocks. I think value stocks are value for a reason. And I think when something is cheap, that's what it is. It's cheap. I associate cheap with garbage. I'm not saying something can't be on sale, but if there's one thing I hate when investors do, and this is a big mistake, and I want to share this with you because I should say hate. That's kind of a strong word. I dislike this a lot. Okay. There's one thing I don't like when investor says, oh, but you're supposed to buy them when they're down. No. That you could apply that to everything then. Every time any stock goes down, oh, you're supposed to buy it when it goes down. No. If a stock is down for the right reason, you shouldn't do it. You should not, absolutely, you should not be buying the stock. If stock is down for a reason, you need to find out the reason. Now, if a good company is down, a growth company with excellent growth metrics is down because the stock market is down 5-10% in a day, I can understand that. But if any random stock is down that you own and it goes down a lot, it doesn't mean you're supposed to buy it when it's down. The biggest mistake is, to me, is averaging down. Investors keep buying more and buying more and buying more, and that $40 stock is eventually down to $4. And I've seen investors lose so much money from making that mistake. So I don't really like quote unquote cheap stocks. Now, if a stock is a decent valuation because it does have good growth characteristics, that's a different story. So let's say a good growth company comes off a little bit. They had an earnings miss, but they still have a good long-term story. And the stock is off a few points. Investors snap those up. That's why when you see a good growth stock go down, the stock recovers almost immediately. Like, they had bad earnings last night. The stock is down a little bit this morning. By the end of the next day, the stock is already recovered. That's the kind of value, if you want to say value, that I like. Okay. The kinds of stocks that I like, if you are looking for a value stock, the way I would look at it is this. There's two ways to go about it. You could look at companies that exhibit characteristics of both. For example, I'll give Apple as a great example of a company that has consistently shown characteristics of both value and growth. Apple has consistently had a fairly low P ratio for the size of the company, the amount of cash it has, the growth it has. Part of the reason is because investors are always worried that Apple is too reliant on hardware, because even though they're moving into software as a service and all kinds of other service businesses, Apple Pay, etc., they are still basically an iPhone seller, a hardware seller. Yes, they're cramming more and more in terms of what you can do on your iPhone. I love my iPhone. But they have consistently shown characteristics. In other words, even though they're a growth company, the stock goes up, it doesn't go up to a point where it seems to have a valuation that is so overly stretched that you have to hold your nose when you buy it. On the other hand, when the stock goes down, it's a value stock, but they still have good growth characteristics, so you can feel comfortable buying it. There's not too many companies like that, and that's why you see Apple clear so many hurdles. The same can be said for other companies like Alphabet and Microsoft. And if you notice, the three companies I just named happen to be three of the biggest companies, the three biggest companies in the S&P 500, which is one of the reasons why the S&P 500 has continuously held up so much better than what is reflected in the general economy. Okay, but more on that. I've been talking about that for a long time. So just to reiterate, cheap stocks I don't like. I don't like stocks at their 52-week low. I don't like stocks that are low PE ratios, and I don't like stocks that are low price to book, because these are just justifications for a stock that's beaten up to get into them. So we're going to avoid those. Okay, that's what I'm going to do. You are free to do whatever you want, but if you're my client, I'm just letting you know in advance. In my process, that's we avoid them. Another way you can pick stocks, and this goes for growth and value. But of if you think about the difference between growth stocks and value stocks, you have to think in terms of growth stocks versus cyclical stocks. Growth stocks are known as companies that grow no matter what. So, for companies growing, they sell toilet paper and toothpaste. Even in a recession, they'll be able to maintain their earnings and revenues. So it's considered growth because they're more or less somewhat shielded against a recession. Cyclical stocks supposedly become values because their earnings and revenues go down when we're going into a recession, and during a recession, stocks go down. And then when we're starting to look like we're getting through the recession, not necessarily when the recession is over, but when an end is in sight in the minds of investors, those stocks go back up because investors expect them to show growth in their earnings and revenues. So cyclical companies have cyclical between their earnings growth and their earnings shrinkage back and forth based on the cycles of the economy. So if you think about those stocks and you see, like we talked about before in the ETFs, the 11 sectors of the market, if you think in terms of like industrials, they're very cyclical. Industrial stocks go down when you're heading into a recession because you expect the earnings to go down. And then when the earnings go down, the stocks go down, but then they become growthy again because when you're starting to look like we're coming out of when we're starting to look like we're coming out of the recession, they start to grow rapidly their earnings and their revenues, and they become growth again. So that's one way to look at value stocks. Another thing to do is you could take a look at some of the investment products out there, and I'm going to show you two quick ones. Then I'm going to end this, and see what their screens are. Let's say you take an ETF for growth stocks or an ETF for value stocks. Take a look at what they've already chosen in terms of growth and value, and then pick from among their holdings. Cherry pick the ones that you like to see. So let's just take a quick share screen, and then we're almost done, guys. Okay, so we're getting through this. Let's take a quick. We looked at this one here. Here's the one I want to show you. Okay, when you're doing the live stream, these computers run a little bit slower, but let's just take a look. You see this green over here where my mouse, the cursor is 280%. I'm going back since inception, so about 2006, 2002. So we're going back almost 20 years, and we're looking at the iShares S&P large cap growth, which is the green. I'm going back even longer, so 305%. The S&P up 209%, and value only up 122%. So we're going back a long time, and you can see that growth has outperformed value by miles. I mean, that is not even close. So a couple of points I'll make. And by the way, if you take a look at their portfolios, so the investment objective of the iShares S&P 500 growth, seek investments that large cap stocks that exhibit growth characteristics. But if you scroll down, let's take a look at the portfolio. You see Microsoft, Apple, Amazon, Facebook, Alphabet, Google, okay, Visa, MasterCard, NVIDIA, Home Depot. Big winners. I mean, huge winners. And then you take a look at the iShares S&P 500 value, and you see, Verizon, AT&T, Berkshire Hathaway. Johnson & Johnson's been a nice winner, but ExxonMobil is down in the dumps for a long time with the price of oil. AT&T has been dead money for ages. Walmart's finally starting to look like it's doing well, but for the most part, these are not the biggest companies, nor are they the best performers because their value, not growth. I'm not saying there comes a point when you could pick up Walmart on the cheap, and a lot of people did, and I hope you did made money on it. But I'm just giving you the characteristics long term of why growth has outperformed value. Okay. So you have to pick your characteristics. Some people define value as a growth stock that goes down temporarily and they pick it up because they see it as a value. I subscribe to that. And some people see a value stock as a company that is in a very cyclical sector that's down, and one day the company will come back. I don't subscribe to that. I don't subscribe to the one day it'll come back. If a company is becoming obsolete, the cost structure no longer works, they have too much money, too much debt. I'm not going to be the one to wait around for the company to recover. So there's my argument for growth versus value, and I hope this helps you to see the difference. Some people argue, well, that value stocks have better dividend income, and I think for the most part that's true. And I just did a whole live episode on dividends, so I don't want to just repeat the whole thing, but value stocks often do have higher dividend yields than growth stocks. But one of the reasons for that is because when a company becomes a value stock, it means that the company doesn't have the same growth prospects that it used to have. So instead of plowing more money into new growth opportunities, what do? They just give more cash out to shareholders because they have no better investment for it, as opposed to growth companies, which often don't show the same dividend, which often don't have the same dividend characteristics. But that's because they're plowing their money into growth. They can grow the company. They can get a greater return by reinvesting cash back into the company's new products and services, and in turn grow earnings and revenue, which should grow the price of the stock. That is a big reason why growth stocks have outperformed value stocks. I hope this helps you with your understanding. I'll just take a look out there. We've got a couple of comments. I always appreciate that, by the way. Got one from James. Every value manager says we've just been out of favor. So true, James. It's there are so many value funds which were like these great vaunted value names, value fund managers in like the 80s and 90s. And like 20 years later, they're still saying, yeah, one day we're going to make a comeback and everybody's going to jump back into these obsolete companies and everybody's just going to buy them like crazy and they're all going to recover. Hope springs eternal. Filippo. Awesome, Mitch. I love growth stocks. Always looking to see long-term capital appreciation as well. Thank you. Filippo, I have to tell you, you asked me a question in the comments, I think from yesterday's live stream. And that's what got the wheels spinning for me to make today's live stream. So thank you, buddy. You see what I mean when I say I get my best ideas from your questions? I could think of what you want to know, but it's better for you to tell me what you want to know, because if you want to know something, there are probably a lot of other investors who want to know the same thing. Thanks, guys. See you soon. And I'll be back tomorrow.